The financial services industry has a massive incentive to make this seem harder than it is. Because if you figured out that you could build serious wealth with 4 exchange-traded funds in about 15 minutes of setup time, well, that's not great for their business model. I'm going to show you exactly how 4 ETFs can give you everything you actually need. Full market exposure, protection when things get ugly, serious long-term growth, and one of them even kicks off enough passive income that by year 30, you're looking at $16,000 a month, not from some complicated option strategy or crypto gambling, just from owning pieces of actual businesses. And before you ask, no, this isn't some revolutionary new strategy I invented. It's actually boring as hell, which is exactly why it works. So here's the thing about most people's portfolios. They're a mess. I'm talking 20 different funds, half of which do basically the same thing. 3 growth funds that all own the same tech stocks. 2 value funds fighting each other. Some random emerging markets play because Jim Cramer got excited about it in 2008. It's like going to a restaurant and ordering one of everything instead of just getting the stuff that actually tastes good. And the worst part? All that complexity doesn't make you more money. It just makes you more stressed. I spent the last month looking at portfolio construction strategies, and I kept seeing the same pattern. The people who do best aren't the ones with the most complicated setups. They're the ones who understand what they actually need and then get out of their own way. Think about it like building a house. You don't need 47 different types of hammers. You need a foundation, walls, a roof, and plumbing. Everything else is just showing off. Your portfolio works the same way. You need 4 things. Broad market exposure, so you're not gambling on which sector wins. Stability from proven companies that have survived multiple crashes. Growth from businesses investing in the future. And income that pays you for holding. 4 roles, 4 funds. Done. Now, you might be thinking, but what about international exposure? What about small caps? What about sector rotation and factor tilts and all that stuff I read about on Reddit? And look, you can do all that if you want, but here's what I've noticed. The people obsessing over their portfolio's Sharpe ratio aren't usually the ones with the most money. They're just the ones spending the most time on it. The actual wealthy people I know, their portfolios are boring, almost embarrassingly simple, because they figured out that complexity is expensive and stressful, and it doesn't actually move the needle. So let me break down what I call the wealth quadrant system. Not because I think I'm clever with names, but because it actually helps you understand what each piece does. Quadrant 1 is foundation. This is your broad market exposure. You want to own basically everything, from Apple down to some random industrial company in Nebraska you've never heard of. 3,600 companies, all in one fund. When tech crashes, maybe healthcare holds up. When large companies stall, small caps might run. You're not trying to predict anything. You're just owning the whole game. Quadrant 2 is resilience. These are the 500 biggest, most dominant companies in America. The ones that have been through the 2008 financial crisis, the 2020 COVID crash, and every other meltdown in between. When the market drops 20%, these are the companies that survive and come back stronger. Quadrant 3 is growth. This is where you tilt toward companies that are actively trying to build the future. They're reinvesting everything into research, new products, expansion, higher risk, sure, but also the kind of returns that can actually change your financial trajectory over 30 years. Quadrant 4 is income. Companies that pay you just for owning them, and not junk companies offering 8% yields because their business is falling apart. I'm talking about stable, profitable businesses with 10+ year track records of raising dividends. Each quadrant does something different, and when you put them together, they don't just sit there independently. They actually make each other stronger. Now, here's where most people screw this up. They hear about dividend investing and think, great, I'll just buy the highest yielding stocks I can find. Wrong move. High yields are usually high for a reason. Either the stock price tanked, or the business is struggling, or both. And when things get worse, that dividend gets cut, and now you're sitting on a position that's down 40%, hoping to earn back your losses at 5% a year. The math doesn't work. Or they go the other direction and decide they're going to pick the next Amazon. They spend hours reading analyst reports, watching CNBC, convinced they can spot the winner before everyone else. But here's the problem. Even professional investors with entire research teams fail to beat the market most of the time. Like, we're talking 70 to 90% of actively managed funds underperform their benchmark over 10 years. And you, reading this, scrolling through TikTok for stock tips from someone who started investing 6 months ago, you think you're going to beat those odds? Come on. This is why ETFs exist. You get instant diversification. You own the winners without having to predict which ones they'll be. And you don't blow up your account because you went all in on some company that had a great earnings call but turned out to be cooking their books. So let's actually get into the 4 funds. For your foundation, you want Vanguard Total Stock Market Index Fund ETF, ticker VTI. This thing holds over 3,600 stocks. Everything from the biggest names to small companies you've definitely never heard of. Apple makes up about 6%, Microsoft another 5%, Nvidia, Amazon, Meta, all the heavy hitters. But here's what's cool. You also own thousands of mid caps and small caps, the future apples that haven't blown up yet. So when tech cools off and people rotate into other sectors, you're already there. When large caps slow down and small caps take off, you're already there. It's boring, it's broad, and it works. Over the last 10 years, VTI has returned about 155% total. That's more than tripling your money. The expense ratio is 0.03%, which in the industry is basically free. You're keeping nearly all of your returns instead of handing them to some fund manager. Current dividend yield is 1.37%. Not huge, but it grows about 6.7% a year on average. And the share price appreciates about 9.7% annually. If you put $9 a day into VTI every single day, by year 10, you'd have about $55,000. By year 20, $240,000. And if you stuck with it for 30 years, you'd be sitting on around $600,000. That's from $9 a day, less than lunch. By year 30, you'd be earning about $3,100 a year in dividends alone. Not life-changing income, but a solid base that required zero stock picking. Now, foundation is great, but you also want focus. You want exposure to the biggest, strongest companies that are leading the market, not just participating in it. That's where Vanguard S&P 500 ETF, ticker VOO, comes in. VOO tracks the S&P 500. These are America's 500 largest, most profitable companies. Apple, Microsoft, Nvidia, Amazon, the whole crew. These companies aren't just surviving the economy, they're running it. When you own VOO, you're betting on the leaders. And historically, that's been a really good bet. Over the past 10 years, VOO has returned about 168% in price alone. That's slightly better than VTI because you're concentrating on winners instead of diluting with smaller companies. The expense ratio is the same, 0.03%. The dividend yield is 1.36%, growing at about 6.56% annually. And the share price appreciates around 10.3% per year. If you invest $9 a day into VOO, you'd have about $56,000 by year 10. By year 20, $216,000. And by year 30, you're looking at about $659,000. Out of that, more than $530,000 comes from price appreciation. Another $31,000 from reinvested dividends. Total value added to your portfolio is about $561,000. By year 30, you'd be earning about $2,700 a year in dividends. Now, you might be asking yourself, why own both VTI and VOO? Don't they overlap? Yes, they do. A lot. But here's the thing. VTI gives you everything. VOO gives you the best of everything. It's like owning the whole league, but also buying extra shares in the championship team. When markets are strong, that focus helps. When they're weak, VOO's emphasis on large, stable companies tends to hold up better. It's not about eliminating overlap. It's about sharpening your exposure. All right, so now you've got foundation and resilience. But neither of those is really built for speed. They're solid, they're dependable, but they're not going to make your portfolio explode in value. For that, you want growth. Enter iShares Russell 1000 Growth ETF, ticker IWF. This fund focuses entirely on large companies that are reinvesting aggressively. They're building new products, expanding into new markets, funding research. They're not sitting around paying fat dividends. They're trying to take over the world. Top holdings include Apple at 11%, Microsoft at 10.6%, Nvidia at 9.2%, Amazon at 6.4%. You're talking about the companies driving artificial intelligence, cloud computing, digital infrastructure, next-gen healthcare. More than half the fund is concentrated in the top 10 companies. So yeah, it's more aggressive than VTI or VOO. But that's the point. Over the past 10 years, IWF has returned 273% in price alone. That's almost quadrupling your money. Over 5 years, 122%. In just the past year, 15.75%. That's not just strong, that's elite performance. Now, this fund doesn't pay much in dividends. Current yield is 0.48%. But that's fine. IWF isn't about income, it's about scale. It's for people who understand that wealth in the early years isn't built from cash flow. It's built from appreciation that you convert to income later. Dividend yield is 0.48%, dividend growth rate is 3.21%, and average annual share price appreciation is 14.03%. If you put $9 a day into IWF, by year 10, you'd have about $64,000. By year 20, $335,000. And by year 30, you'd be looking at about $1.2 million. Almost every dollar of that growth comes from capital appreciation, not income. And that's exactly the point. IWF is your accelerator. It brings speed and ambition, but it also brings volatility, which is why you don't put your entire portfolio in it. Now, growth is great for building wealth, but not everyone wants to wait 30 years for their portfolio to start paying them back. Some people want cash flow now. They want to see money hitting their account every quarter. That's where the fourth quadrant comes in, income. For this, you want Schwab U, S Dividend Equity ETF, ticker SCHD. If there's one fund that deserves the label cash flow machine, it's this one. SCHD only holds companies with strong balance sheets, solid cash flow, and a proven history of paying dividends. To even be eligible, a company needs at least $500 million in market cap, minimum $2 million in daily trading volume, and 10 consecutive years of dividend payments. Once they pass that screen, the fund evaluates them on 4 factors: free cash flow to total debt ratio, return on equity, dividend yield, and 5-year dividend growth rate. Only the best make it in, and the final portfolio is capped at 100 stocks, with individual holdings limited to 4 to 5% and sector exposure capped at 25% to maintain diversification. Inside the fund, you'll find companies like Coca-Cola, Verizon, ConocoPhillips, Lockheed Martin, Home Depot, AbbVie, Amgen. These are firms that have weathered multiple economic cycles and kept rewarding shareholders through all of it. SCHD is diversified across sectors, heavy in consumer defensive, energy, healthcare, industrials, financials. These are industries that tend to hold up well during downturns, which is why SCHD often performs with surprising resilience. Over the past year, SCHD returned 1.18% total. Over 5 years, 58.52%. Over 10 years, 94.43% in price return alone. Current dividend yield is 4.04%. That's real income, and it's distributed at about $14 per share annually, with an expense ratio of 0.06%. The dividend growth rate is 11.3%, and the average annual share price appreciation is 6.83%. Now, let's talk about what happens if you commit to this long term. If you invest $9 a day into SCHD, your portfolio could grow to nearly $58,000 in 10 years. After 20 years, about $291,000. And by year 30, you're looking at approximately $1.69 million. By the 30-year mark, this fund would be paying you about $200,000 a year in dividends alone. That's over $16,600 per month. More than $1.08 million of that total value comes just from reinvesting dividends. Another $588,000 from capital appreciation. Total value added to the portfolio is $1.596 million. SCHD doesn't chase moonshots. It doesn't try to double overnight, but it delivers something just as powerful: stability, sustainability, and the kind of income that can actually give you financial freedom. So now you've got 4 funds: foundation, resilience, growth, income. But here's the thing. Depending on where you are in life, there's more than one way to use this setup. You can take the same building blocks and shift the weight to match your goals. Some people want their portfolio to start paying them sooner. Maybe they're thinking about early retirement. They want income now. Others are laser focused on growing their money as fast as possible and letting it compound for the long haul. Both approaches are smart. Both are simple. And both are built with purpose. Let me show you 2 real strategies using these same 4 funds. Strategy 1 is the dividend-focused portfolio. This one is designed for people who love the idea of getting paid to own great companies. It generates solid cash flow, but still gives you long-term growth. Here's the allocation: 70% into SCHD. That's your workhorse. The high-quality dividend ETF filled with companies that don't just pay dividends, they keep raising them. Then the remaining 30%, 10% each into VTI, VOO, and IWF. That gives you full market coverage, large cap stability, and a little extra growth potential without overcomplicating things. Now, let's talk about how we figure out the income this portfolio actually produces. Each ETF has its own dividend yield. SCHD is at 4.04%. VTI is 1.37. VOO is 1.36. IWF is 0.48. But you're not putting equal amounts into each one. You're putting way more into SCHD, so its impact should be way bigger in the final number. You calculate the weighted average by multiplying each ETF's dividend yield by how much of the portfolio it represents. For SCHD, that's 70% times 4.04%, which gives us 2.828%. Then we do the same for the others. 0.1 times 1.3 minus 7% equals 0.1 minus 3 minus 7%. 0.1 times 1.3 minus 6% equals 0.1 minus 3 minus 6%. 0.1 times 0.4 minus 8% equals 0.0 minus 4 minus 8%. Add those up. 2.8 minus 2 minus 8 plus 0.1 minus 3 minus 7 plus 0.1 minus 3 minus 6 plus 0.0 minus 4 minus 8 equals 3.1 minus 5%. That's your real total dividend yield for the whole portfolio. Same kind of math for dividend growth. SCHD has been crushing it with over 11% annual growth. VTI and VOO have been solid too. Even IWF contributes, though it's more of a capital appreciation play. When you weigh those based on how much each ETF contributes to the mix, you get a dividend growth rate of about 9.56% per year. Now here's where it gets exciting. If you invest $9 a day, every single day, and reinvest all the dividends back into the portfolio, after the first year, you'd have about $3,285 invested. Stay the course. And by year 10, you're looking at $57,000. 2 decades in, it grows to $234,000. And if you stick with it for 30 years, you'll be sitting on $826,000. By that 30th year, this portfolio would be paying you about $34,100 every single year. That's over $2,800 a month. If you add it all up, the capital growth plus all the reinvested dividends, you're looking at a total value added of $727,500 over those 3 decades. About $476,500 comes from price appreciation, and the rest, a solid $251,000, is from reinvested income. But maybe you're not looking for income right now. Maybe you've got time on your side and you're in full growth mode. You're not thinking about cash flow yet. You're focused on building a big, powerful portfolio that can give you options later. That's where strategy 2 comes in, the growth-focused portfolio. This one's built for people who aren't worried about income today. Maybe you're in your 20s, 30s, even 40s, and you're thinking long-term. You've got time. You want that snowball to get as big as possible before you start living off it. So instead of focusing on dividends, this portfolio leans into fast-moving, high-growth companies. You're still diversified, but the goal here is simple. Grow your money as much as possible, as fast as possible, with smart, broad exposure. Here's the setup. 70% into IWF. That's your high-growth engine. Then, to keep things balanced, you add 10% into VTI, 10% into VOO, and 10% into SCHD. VTI gives you a piece of everything in the market. VOO adds large cap stability. SCHD throws in a little income, even though that's not the priority. If you allocate this way, the overall portfolio will still have a yield. It's just low, around 1.02%. And that makes sense. This portfolio is focused on appreciation, not income. Same goes for dividend growth. Since we're not building around SCHD this time, the average growth rate is lower, about 4.71% a year. It's there, but it's not the priority. Where the strategy really shines is in share price growth. When you look at how fast these ETFs have grown in value, especially IWF, the numbers are seriously impressive. Weighted together, this portfolio's average annual price appreciation is around 12.51%. That's where the firepower comes from. So let's run the same $9 a day scenario and see what this thing can do over time. After year 1, just like before, you'd have $3,285 invested. But hang in there. And by the 10-year mark, you'll already surpass the dividend-focused portfolio, valued at around $61,000. Stay consistent, and by year 20, you'd hit $264,000. Push all the way to 30 years, and this portfolio could grow to around $927,000. That's nearly $1 million portfolio. And remember, that's without chasing high yields or trying to time the market. Just consistent investing, reinvesting everything, and letting the math do its thing. Now, the dividend income from this strategy is not much. By year 30, you're getting about $794 a year. That's around $66 a month. But that's a trade-off. You're not collecting big checks today. If you look at the total value added over those 30 years, it's even bigger than the dividend strategy. You're looking at $829,000 in total gains, with $817,000 of that coming purely from price growth. Only about $12,000 came from reinvested dividends. It's a totally different approach, but the logic is just as sound. Now, the real question becomes, which of these feels more like you? Because neither is better or worse. They're just different tools for different goals. If you're in your 20s or 30s and you've got decades ahead of you, the growth portfolio probably makes more sense. You don't need income now. You need your money to compound as hard as possible. If you're in your 40s or 50s and you're starting to think about what life looks like when you're not working 60 hours a week, the dividend portfolio might be the move. You're building toward cash flow that can supplement or replace your income. But here's what both strategies have in common. They're simple, they're boring, and they work. You're not trying to outsmart the market. You're not chasing the next Tesla or trying to time the next crash. You're just owning pieces of businesses, reinvesting the profits, and letting time do the heavy lifting. And that's the part most people miss. Investing isn't about being clever. It's about being consistent. The people who get rich from the market aren't the ones making the smartest trades. They're the ones who started early, put in money every month, and didn't panic when things got ugly. Because here's the thing nobody tells you. The market is going to crash again, probably multiple times over the next 30 years. And when it does, you're going to see your portfolio drop 20, 30, maybe even 40%. And that's when most people screw up. They panic, they sell, they swear off stocks forever and put everything in a savings account earning 0.5%. Meanwhile, the people who stay the course, who keep buying through the crash, those are the ones who end up with seven-figure portfolios. Because crashes are where wealth gets transferred, from the people who panic to the people who don't. So if you take anything from this, take this. Pick one of these two strategies. Set up automatic investments, and then forget about it. Don't check your portfolio every day. Don't read the headlines screaming about the next recession. Don't let some talking head on CNBC convince you to sell everything and buy gold. Just keep putting in your $9 a day or whatever amount works for you and let the system do its thing. Because in 30 years, you're not going to remember the day-to-day noise. You're just going to remember whether you stuck with the plan or not. And if you did, you'll have somewhere between $600,000 and $1.2 million to show for it. Not from picking stocks, not from timing the market, just from owning 4 funds and not getting in your own way. That's the whole game. Everything else is just noise.